Here we go. We're gonna start recording. So once again, thank you everyone for joining us today. We are very happy to have Rob Daniel from Securian to go over. I think is a pretty cool sales idea in regards to 1035 strategies and LTC. So our goal today is to make sure that, or hopefully that you come away with number one, a strategy. You can go through your client list and hopefully find one or two people that you can help with this new strategy that Securian and Rob is going to present. With that, Rob, I'm going to hand it over to you and let you do your thing.
Awesome. Thank you, Lewis. So I am Rob Daniel, RVP with Securian. I'm on the individual life side. So today we're going to talk about split 1035 exchanges and looking at the long-term care market with life insurance as an alternative to the individual long-term care policy. So I'm going to go ahead and share my screen here, PowerPoint, and we'll go ahead and get started. Here. Okay, hopefully everyone can see the screen here. So again, we're going to go through a more or less a training of the market for long-term care and some of the thoughts and sales ideas that we've had within this market. This market, especially for Securian, has attracted a lot of sales for permanent life insurance. And we were actually one of the first companies to come out with hybrid long-term care strategies, meaning using life insurance as that strategy versus traditional long-term care. So we'll go through that a little bit. And I'll show some case studies at the end. And if we get, we'll definitely have time for questions at the end. So for those not familiar with Securian, we Securian Financial, and also my email us as Minnesota Life. We are a mutual holding company, so we're one of the strongest and most conservative carriers in the marketplace. You can see our Comdex rating at 96. We have one of the highest Comdex ratings on a non-whole life carrier basis in the marketplace. So definitely, if you have any questions about Securian, we can provide information to you, but as you can see, our ratings are extremely high. And it's one of the reasons we get a lot of advisors to get appointed to custody for policies that fit your clients. So let's talk about long-term care market. So I've been in the industry 35 years and selling long-term care for a majority of them back when we first started having individual long-term care contracts. And for those who have sold those in the past, there's obviously issues with those policies, especially some of the in-force ones that weren't priced correctly. And today's more or less an education of what's out there in the marketplace and what we can do to help our clients. So definitely the needs there. And I see this as a conversation for most financial planners. And most clients really, I think, feel that they're going to need some sort of long-term care. Just you got to figure out how to pay for it and how to provide for that within the financial plan. You can see the cost here, a median cost between 50 and 100,000. I would say more on the 100,000, but depends on the area you're in. And it also depends on the type of care that you have, and we'll talk about that as well. Now, the concern, and more or less, this is a lot what we hear from planning clients, that most people, if they need care, would prefer to be at home, which makes a lot of sense. What people don't realize is that cost for care at home, while it's desired for most people, it's actually in some cases more expensive to do that. So again, proper planning is the key to this to make sure we can fit that desire within the financial plan. So here's a snapshot of annual care, and this slide we actually do some different things with it based on where we present this, and I just did this for the Southeast. So you can see we took a snapshot of Florida, South Carolina, and Georgia, and then a U.S. average. And so I want you to look at these numbers, and what's interesting about these numbers is I want you to look at the home care. So you got home health aid. Let's just take an example since Lewis is in Florida there. Let's take an example of that. So home health aid in Florida is $68,640. Where assisted living is $57,000, and then the nursing home goes up to $136,000. So a lot of people ask, well, why is home care that much more? And for those who have sold individual long-term care policies, especially 10, 15, 20 years ago, and remember the company in January, this was a big selling point of those policies, especially the ones that really geared towards home care. In fact, the January policy, which I sold back in the day, was a great policy, great benefits, but it was really based with, it was a zero elimination day period for home care. It was really built for that. And we saw the issues because there was premiums on those policies that gone up because individual long-term care premiums can go up. They're not locked in. And the whole idea of the home care, again, it's desired, but what has happened here, especially in the last 5 years, is home care has gotten really expensive. So this is usually where I tell my the background of kind of where I come from on this. So I've been in the industry 35 years, but I'm also doing through this with my mom and dad. My mother and father, my dad's going to turn 90 this year. My mother is 87. They are both in assisted living, and then over the last several years, we've had to move them from the home to independent care to the assisted care. And when we started seeing issues where they needed more care and we need to help them out more than what we could provide as a family, we started looking into home care, and that was particularly what my dad was home care. And my dad, by the way, was somebody that did not believe in long-term care insurance. He refused to buy it over the years. And even though my mother had health issues, he could have bought it. And actually, where we are right now, he really does need it because he's having memory issues and started dementia. So with that, we started at the home, started home care, and depending on the area, home care varies in cost, but I'm out of North Carolina. My mother and father are in North Carolina. They're in a very, very nice place, very safe, feel very good about their care. But when they're there and when we're doing the home care on independent living, we were looking at about $24 an hour for a home care, which one of the definitions of that is more or less a babysitter, because those home health aides in a lot of cases cannot administer medicine unless they are a certified RN. And if you get one of those to help you out as a home health nurse, then you're talking about $45, $50 an hour. So when you start talking about average cost, you also have to ask how many hours a day. And if you have somebody with memory issues, it's more than 8 hours a day. And especially depending on the condition that they have and the ADLs that they're suffering from, you start looking at more than 16 hours a day, this can get really expensive. So one of the things we had to do as a family is to find an opportunity at an assisted living facility that would save the family money, which you could see here. Again, while not a perfect situation, but it gives you care, safe, and if something happens, somebody's there and there's a nurse there 24 hours. That's what we need as a family. And in a lot of cases, from a planning standpoint, what most families need. So clients need to understand the home health aides and the home health nurses. The cost of those now, especially the longer they're in the household, costs a lot of money. Now, if you start going in the nursing home, again, really expensive. So we got to figure out how to fund these, right? And not only fund them today, when we're looking at planning, we need to fund them for the projected costs. So not to scare anyone today on a Wednesday afternoon, but we got the cost here projected over to 2048. So you can see how much this looks to increase. And this is just the normal inflation of what we're seeing with long-term care costs, which is, depending on the area, 5 to 7% increase every year. So we got to figure this out. We got to figure out funding. And there's no one great solution to this because, again, it's about leverage. How can we look at, from a financial planning standpoint, how can we take assets that we already have or income and leverage it to be able to provide benefits for these individuals? And again, it takes proper planning, but it also takes creating an asset, maybe taking an asset away from managed money type of assets to be able to then reallocate to create a long-term care fund. And that's really what we're talking about, because we've got to figure out a way to pay for this care. So there's 4 generic ways to pay for care. Self-fund, like my family, my dad chose. And when he chose self-fund, I don't think he realized the fact that he always thought that he, being the caregiver of my mother, would be able to take care of her. He never got the idea, the fact that what if he couldn't take care of her? And that's where we are right now. So your self-fund's expensive. So I can tell you, In Greensboro, North Carolina, for my mother and father, it runs about 16,000 a month. And the hard issue with this is if you don't have non-qualified assets, that's going to come out of qualified assets, which then you're going to have to pay taxes. So you can see the kind of liquidation the state could go through with self-funding. And if you look at the 4 ways to pay care, self-fund is you could draw a line connecting the family. So obviously another way is that family thing. Well, family on a self-fund is going to be involved no matter what. And usually family's going to be involved no matter what anyway. But is family close by? Is family willing to then take care of an individual? Well, I know there's situations where you have that, but again, having assets in an asset class for long-term care to help provide for that really releases a lot of the burden on the family and releases a lot of stress for the families. Then you got government. So I think we know from government, Medicare is not going to pay for long-term care. Medicaid will, but then you have to do the Medicaid spend down, which again, issues with that as well, especially getting assets out of the state. So again, not a great solution there. And then you have insurance. And with insurance, you have to make sure you get insurance while you're insurable. So a lot of people end up waiting too late. We have a screen here. I'll show you the declaration rates of long-term care, but you use the insurance or the leveraged asset route. Advisable to start looking at this as early as you can, or at least locking in some sort of coverage because of that insurance. I'm going to stop right here. Any questions so far? Okay, we'll go to the next screen again. We'll have time for questions later. So here's the type of long-term care insurance that's out there. So if we use the leverage route, and I like to use the term leverage with this, because you're taking $1 of premium and creating long-term care leverage dollars, which again, that pool would be the base for being able to take expenses out. So you got the traditional long-term care insurance. Again, we talked about earlier with Genworth in the past. Today, it's a limited list of who offers this. No Mutual of Omaha is probably the bigger one I see in the marketplace, but again, there's a monthly or an annual premium you got to pay. Sometimes you can get a reasonable rate with this, but it's a life pay. And if you never use it, you lose it. But your risk here is your premiums go up. And I think companies now have really repriced them based on what they've seen in the past. And again, premiums could go up with traditional long-term care insurance. And a lot of people look at this and say, okay, if they can afford it today, what could it be in the future from a premium standpoint? But the other aspect of it is that if you never use it, it's like health insurance. There's no residual benefit at the end. So then you have life insurance with accelerated benefits. So this is where Securian has really niche in the marketplace. We were one of the first carriers to do this. Actually, Securian used to sell the individual long-term care contracts and looked at it and looked at what was going on with Genworth and was saying, where do we want to be in this marketplace? What type of policies make sense? And we felt that when we do a good job of life insurance, but if we just figured out an actuarial cost to pay it early, and that then helped us develop on our IUL portfolio a life insurance policy with access accelerated benefits for chronic illness of the death benefit. So this is where you can access pretty much 100% of the death benefit with most carriers. I know with Securian, it's up to 100%. And you retain ownership or retain liquidity and flexibility in the contract. So it's a great way to do this. Plus the fact that the cost for putting a rider to pay the death benefit early for long-term care, it's a fraction of the cost. It's just the actuarial cost to pay it early. So it's very cost effective from that standpoint. Really, the only cost to it is the cost of buying the life insurance. Now, the only disadvantage with doing this type of solution is the benefits are capped at the face value. So there's no inflation protection. You're not going to get a raise in benefits. So you just got to make sure if you use this type of benefit that you know that you write enough life insurance that it's going to provide for that long-term care policy. The third option is annuities with long-term care riders. So this is new within the marketplace. I am not the annuity contact at Securian, but we sell a lot of these. Again, very different with carriers, and the insurability factors of that have changed over here the last couple of years. So definitely reach out to your annuity contact if you see the opportunity for this. Now, the big deal with this one is limited underwriting, so it's different than qualifying for a life policy with a rider or even traditional long-term care. So there's difference. So again, reach out to your annuity contacts for this. But a lot of times this is more the plan B type of planning where somebody really wants that limited underwriting, limited questions, and be able to easily qualify for something like this. And it's more of a reimbursement model. So it's not going to be the cash again. And that's also a signature of Securian. So with Securian, both on the life insurance policy with the chronic illness rider and the next product I'm going to show you, the hybrid, all the benefits within Securian are all cash indemnity, which is the best way to pay for the plan standpoint. So let's talk about the fourth method or fourth type. It's the life insurance hybrid product. So at Securian, this is called Securian. So this is a product that is more based on long-term care versus life insurance. It is a life insurance policy, but it's built differently. So this one, you're going to do a short pay. So it's going to be either a 1 pay, 5 pay, 7 pay, 10 pay, 15 pay. And it's going to immediately buy long-term care leverage or pool of benefit, depending on your age. It could be 2, 3, 4 times that premium you put into it. And if you pass away, the death benefit's going to be really small, right? So the focus is not on the death benefit. It's going to be, can we provide more long-term care than the individual life solution, plus provide an inflation benefit? So that's the other advantage of the hybrid, is that you could choose 3%, 5% simple or compound inflation, and that benefit can grow. And that's where a lot of times you hear the term leverage, in that you're taking premium dollars and you're leveraging it into a qualified long-term care plan that actually grows in benefit. And that's the So let's talk about underwriting. So always get questions on long-term with underwriting, and this is more of an industry statistic here, but this is the declination rate for long-term care. Obviously, the longer you wait, the older you are, the tougher it is to get. So I like to circle on this page ages 50 to about 65. That's your best opportunity to get these policies. You can see the declination rate very well. You start getting 65 and older, specifically 70 and older. 70 and older, it's almost 50%. So we do a lot of older age long-term care cases, but again, you're always fighting the underwriting with us. And remember, long-term care, it's different underwriting than life insurance. So if you choose the individual life insurance model with the rider, what's going to happen is you go into underwriting, it's going to underwrite and give you a life insurance rating class, and it's going to give you a chronic illness rating class. So those classes are preferred, standard, plus, and standard. Now, on secure care, that one benefit, a little different. That secure care, since it's more of a long-term care type company, it's going to be underwritten as long-term care, and you either get it or you don't. There are no rating classes. So it's either a yes or no. So we always try to talk to people about the cost of waiting. And again, the earlier you can secure coverage from an insurability standpoint, the cheaper it is, easier to get it. So this is an example of what we see in a planning standpoint. And I always give the example of this with my mother and father, as we've had to do planning with them. And again, this is kind of an ideal scenario where you have all these sample portfolios, so liquid assets, stocks, real estate, bonds, IRAs, qualified accounts, mutual funds, annuities, and life insurance. Right. So this is a scenario where you don't have long-term care. And we always talk about a concept within financial planning with life insurance as an asset class, which I love. Those life insurance cash value, it's deferred, free, and that life insurance aspect of your portfolio, we feel is more important. We feel it needs to have a dedicated asset class. Well, then the question comes is, should long-term care also be one of these five pieces? Do you have long-term care as that asset class as well? Well, if you don't have it, you have your income here as the example, and then you got your living expenses. Well, then you also have long-term care expenses. And this is the hard part of home care, because with home care, you're at home, you've got living expenses of maintaining a home, and then you have the care of caregivers coming in to take care of you, which at the rates that they're charging per hour is more than facility rates. So this is where we really got to build a plan within their portfolio. How do we pay for this? Now, this sample portfolio is more of just a generic whiteboard sample. Most people's portfolios don't look like this, especially when they're 80. And this is very similar to my family. So my dad had a lot of these items in that safer portfolio when he was 60, 65. But as he got into his 80s, sold off a lot of it. And what ended up is his pie was really based with IRAs and qualified accounts and cash and his home. And that was it. So if you have that, then what are we taking out to pay for long-term care expenses? Because the living expenses come out of income, they come out of Social Security, they come out of a pension account. It's also coming out of these qualified retirement dollars. So if we all of a sudden have to take more out of the qualified, then we're dipping into principal. And that's where you have the asset spin down these portfolios, where especially if you manage assets, there's not going to be any assets left once we go through a long period of long-term care plan. So this is what we want to try to do as an ideal portfolio. And we try to whiteboard this and really talk to clients about the fact that let's create that long-term care asset class. Let's create it with leveraged dollars. Now, the arguments with it, especially with the client that said, well, long-term care is expensive. Think of the cost. Well, it could be the longer you wait. But maybe another way to look at it is that, yes, it could be paid through income. But what if we figured out a way to reallocate an asset to then create leverage for long-term care? And that's the whole idea of the split 1035, or maybe it's taking money out of a CD, maybe taking money out of cash accounts or non-qualified assets. Investment advisors reallocate all the time. So maybe on a reallocation of a non-qualified asset, a cash asset, or a existing life insurance policy, assuming health, is there a way to then take those dollars and move it from one piece of the pie to another, then to reallocate to create that long-term care leverage? When you create that long-term care leverage, that long-term care policy, whether it's the life policy with the rider or whether it's a linked benefit contract like Securian, this is qualified long-term care. So that means that when you use it to claim, it comes out income tax free. So let's take an example. So this is the title of the presentation, Split 1035. So this is one idea from this. We've seen a lot of these opportunities over the last 6 months. Let's take this example of a 55-year-old male, $200,000 of cash value on a life insurance policy, right? So this is actually built off of a real case, right? So the death benefit in this case was around 500,000, 200,000 of cash value. So Securian is one of the few companies that actually will allow you to split the exchange into two policies. As long as those two policies are with the same carrier, you can do it. Again, we're going to show that with an individual life policy solution and a linked benefit solution with Securian. So with this 55-year-old male, we're going to take $120,000 and we're going to put it to Securian. So this is a one pay going into that linked benefit contract that's going to have low death benefit, but a high pool for long-term care. And as you can see, at age 55, you could buy a lot of long-term care. So it immediately creates a death benefit of $205,000. So again, you could buy a lot more life insurance with $120,000 on a one pay, $205,000. The point is, you're going to have lower death benefit, but have the benefit really being on the long-term care. So by age 85, it's projected that $120,000 sitting in that secure care contract is going to be worth $1.6 million of long-term care benefit by age 85. So we've transformed this contract to a solid long-term care benefit plan. But then on the other end, the kind of the point of this transaction is that, especially if you get good health on the client, can we design this where we can come as close as we can to match the death benefit that they had and provide a lot of long-term care with an inflation-bearing benefit? So that long-term care benefit with Secure Care, that had a 3% compound inflation. So great benefits. So that benefit's increasing, right? So with the Eclipse Protector, I'm taking that remaining $80,000 to buying as much death benefit as I can as a one pay. And you could see I put the rider on it as well. So I gave more long-term care there as a benefit. So I was able to, if you add up the contract, I was able to come really close to what we had before. but provide from a long-term care benefit standpoint, 1.9 over 1.9 million of long-term benefit, long-term care benefit. Which again provides a solid benefit because you got the secure care with inflation, and then you got the protector giving us death benefit we need to match what we had before, plus provide a backup from a long-term care standpoint to the secure care. I'm going to stop right there. Any questions? Okay. Let's go through another case example, and I'll get into kind of the definitions of going on claims. So I am going to share a different screen here. Second. And then there we go. Okay. So what I wanted to show on this is what does a chronic illness agreement look like? And some of the definitions. So this is a chronic illness agreement on an individual policy, right? I'll give you an example of how one works. But
Hey,
typically,
Rob,
yes.
all we see is a very beautiful blue flower.
Oh, well, there you go. Let's try this.
I mean, it is a nice flower.
It's a nice flower. Well, the quality's great, isn't it? Bear with me a second here. It is sharing on my screen. This is really interesting. Oh, we're going to stop share here. How about this? Let's try this again. I bet this will work. How about that? Is that better, Lewis?
You're good.
All right, good. So this is the definition of a chronic illness agreement. So typically when you choose one on the application, it's going to be a choice of a 2 or 4% monthly benefit. And that is done at the application. And this is a chronic illness agreement. So all you need is to be life insurance license to sell this. And everyone asks about the definition of going on claim. So the definition is actually right here on the glossary. So it's being unable to perform without substantial assistance from another person at least 2 activities of daily living or a loss of a cognitive function for at least 90 days. So the 90-day elimination period is in place. One interesting piece to this is that you're paying a life insurance premium. Well, if you're paying premium and you need to go on claim, you wait 90 days, you complete, or your family completes for you, a 3-page certification signed by the doctor saying that you cannot perform 2 activities of daily living or cognitive. And after that, we start writing a check with no receipts. It's indemnity. So we start writing a check up to that monthly maximum. So as an example, if you have a 4% rider on a $500,000 contract, that's up to $20,000 a month, dollar for dollar out of the death benefit. But typically, you're going to do 100% of the death benefit as chronic illness. Now, that is also subject to the per diem. So the policy benefit is going to be capped at whatever the current per diem is. But that per diem again increases over time. So having a benefit of $15,000-$20,000 a month today, if they're in the 50s and 60s, actually is a pretty effective benefit. And you can see here there's a different definition for New York. It is similar. And by the way, for those who do business in New York, we are Securian is actually one of the most competitive products in the state of New York for this. So definitely check us out and call Lewis about that. But again, that's how it works. I'm also going to show a highlighter here. This is the typical ages. So it's going to go up to 80. Now, for those in Florida, our rider is capped at 65, but there is a however to this. We are actually introducing a true long-term care agreement in June that's going to allow Florida clients to actually go up to age 80. So there's always a bias, what's the difference between chronic illness and long-term care agreement, right? Well, it's the same definition, very similar. But if you use a long-term care agreement, it's going to actually add a residual death benefit of $10,000 if they use all of the claim or if they exhaust the whole life policy. So that's good. Plus, there's a caregiver benefit here. So that's what we're going to be introducing in June. We look forward to it. But again, Florida, we're going to be at the age 80 for that. The other thing I wanted to point out too is benefits outside the United States. If you ever get somebody that plans to be overseas when they go on claim, if they buy the policy in the United States, we are one of the most liberal for paying benefits outside the United States. So the monthly maximum benefit is unchanged. So we pay up to the monthly maximum benefit that we receive 100% of the benefit. The benefits just need to be paid in U.S. currency to a U.S. bank, and the proof of claim must be provided in English, and it must be certified by a licensed healthcare practitioner that's licensed in the United States. So really, that's it. It's very simple, it's transparent, it's straightforward, and it's tax qualified. So let's go through an example here. So this is the individual policy. We our IUL policy is Securian Public Protector. So this is a example of a 50-year-old female preferred, needing $500,000 of coverage. So with Eclipse Protector, this is typically a policy where you put a no lapse guarantee on the design. So one of the advantages of Securian is that we are one of the best price contracts, especially on short pays, for guarantees age 100 or longer. And our system defaults to 120. Now, one of the reasons we like the age 100 or longer is we want to make sure we pay a death claim. There are a lot of cases that are in force in the industry that are set to run out at age 85, 90, or mortality type of situation. And we just don't like those cases. We like the more guaranteed cases for life. So you'll see our policies actually default to 120. Now, could you write us at 95 or 90 on a guarantee? You sure could. But to get the best pricing, it's going to be 25 default. So you can see how I built this. So I built it actually with 3 premium choices. The one on the left is a pay for life at $51.98. Again, the $500,000 is guaranteed. It's got a 4% chronic illness rider up to $20,000 a month. So the death benefit is guaranteed, the chronic illness is guaranteed, and Securian has a benefit where if you go on claim, we guarantee that the policy will not lapse while on claim, even if premium payments are not paid. So that's an awesome guarantee. So whether you are paying a life pay, or in the middle one where you're paying a pay to 65, or a one pay. Now, when you start doing these short pays, what you'll see is Securian is one of the best companies for us. So this is where Lewis sees a lot of the quotes with us, especially on 1035s and these short pays. And part of the reason we promote the 1035 split is because we're just a really good product and choice for that from our pricing. And you can really look at that one to the far right, that 99,000, call it 100,000, buying $500,000 of leverage, income tax free from a death benefit standpoint and chronic illness. That 5-to-1 leverage is fantastic. You can see the cash value grows. It really, truly is an asset within that portfolio. So when we talk about having that long-term care life insurance asset class, the short pays really do a great job at that because that cash value, the cash surrender value is that asset. And in a lot of cases, the money they put in, it grows more than what they put in. And again, it's that asset that really is leveraged well with it. So again, 3 choices, better premium savings for the client, definitely it's the short pay. And you can see that, or if you pay a life pay over 30 years, it's $155, almost $156,000 of premium. You just do the pay to 65, it already saves them $20,000. But if they live, greater than 80, you just keep paying into this. So it gets a lot more expensive than if you had just paid a little bit more and cut the premium off, whether it's a 10 pay, 15 pay, 20 pay. And again, 1 pay definitely is the cheapest way to do this. Now, from a pricing standpoint, the marketplace, there's an anomaly within this business right now with these no lapse guarantees that the short pays are really well priced. I don't know how long they're going to continue that, but any of these short pays in the 1 pay, it's a go-to for a lot of financial planners because they know the pricing is really good. And then how Securian compares with other carriers. You could see another example of these single pays. And I mentioned single pays, and people like, well, people writing checks for these type of contracts like this. And the answer probably is no, because I don't see a whole lot of checks. I see wires, I see EFT transfers, but yes, they are doing this, especially if they have the cash. But majority of these cases, 1035 exchanges, it's that split 1030. And you can see here, we compare very well with the single pay. And even on a 10 pay or a full pay, we are right there. And I win a lot of full pays. We'll be in the top 3. Again, depends on rating class, depends on age. It seems to be the older the person is, the more competitive they're going to be on life base, but I don't lose very much on fitness. Now, let's just say if you got a client, love the idea of doing an individual policy with the long-term care agreement or even the security, but they can't afford the permanent solution right now. Just want to throw out, I don't do a lot of training on term because term is term, but we do have a very unique rider called the chronic illness conversion agreement. So if you sell a term policy, issue ages 16 to 60, you use this rider. This rider is very cheap. And what it allows you to do is underwrite the chronic illness when you're doing the term policy. So remember, there's a life insurance rating class, and then there's a chronic illness rating class. Chronic illness rating classes are preferred, standard, plus, and standards. There's three of them. You can get the term policy underwritten, put this rider on, and it allows you to convert to any one of our individual policies at the time of conversion, up until 65. So you got to convert this rider by 65. Now, our term policies, you can convert up to 75, or the allowable conversion period. But for this rider, you're going to convert before 65. So if you convert it, then you convert it to any one of our policies at the shelf at the time. And you will then have the permanent chronic illness agreement on that permanent policy. So you're now going to qualify at an older rate. So this has been really popular for 30, 40, 50-year-olds. Think about a 50-year-old is not ready to do a permanent chronic illness long-term care solution, but you know they will be in the next 5, 10 years. We'll write a 10-year term policy with this rider, and then it allows you to convert. So again, a great opportunity for that. I want to end with a case study for Securian. So I talked to you about this hybrid solution, right? So this is the Securian contract that is a life insurance contract, but it's a little different. So this is an example of a 60-year-old female. This is one policy where there's no rating. You either get it or you don't. But this one also has a couple's discount. Now, individual policy riders don't have this, but if the person is married or in a long-term relationship, you can actually get a couple's discount. And so this is an example of $100,000 single pay. Again, you could do a 1 pay, 5 pay, 7 pay, 10 pay, 15 pay. The best pricing of these is the 1 pay and the 10 pay. So you can see it's a 6-year total benefit, 3% compound interest. So the day one benefit, you put $100,000 in, it creates a $433,000 per. And you can see the monthly benefit there, and then annualized, but that's the immediate pool you create. But then with the 3% compound inflation by age 85, you have over $900,000 of long-term care benefit, and your monthly benefits $11,702. So one of the reasons that split works really well is the split allows you that backup on the individual life policy when you need more than this particular contract, especially on a monthly basis, but it then also increases your pool. So again, same 90-day elimination period. You'll notice the face amount of $134,000. That's the death benefit. So if the person died, they get a little bit more than what they put in, but better than an individual long-term care contract. Individual long-term care, you pay for it like health insurance if you never use it. Those, at least with this, you're guaranteed a little bit more back from the death benefit standpoint. And if you use all the benefits, there is a residual minimum benefit. So that is our presentation today. I'm going to stop here. I've went over a lot of material, both from a market standpoint with long-term care, with strategy with the split 1035, and also the different policies from the protector or the IUL, it's guaranteed, with a no lapse agreement with a chronic illness benefit, with a long-term care agreement that we're going to introduce in June, along with the Securian hybrid. That is perfect for the split 1035 solutions. So I'm going to open up any questions.
No questions. That means you did an excellent job.
Again, if you have any questions, just send an email to Lewis and we'll get it answered for you. If you have a case that you're thinking about and you want to look at a proposal, just let us know. Sometimes when you do the split 1035, it takes a little bit to look at the right mix of how much you put into each contract. So there's not one template with it. It's more of a case by case situation, but definitely it's a great opportunity And again, that's also assuming you got a client that's in good health. And even if they don't have an existing cash value life insurance policy, say all they have is term, you could still do this with just reallocating an asset, whether it's through income and just paying for it as a premium, like on the individual side, or just reallocating an asset to secure. There's lots of different solutions. If you really think about with your clients, how can we create that long-term care asset class and make it more of a piece of their portfolio versus looking at it as a true cost or expense? This truly is an asset in your client's portfolio.
Absolutely. Any questions before we wrap up? Awesome. All right. So once again, Rob, I want to thank you for taking the time out to share this presentation with this group here today. Hopefully, you guys have found some value to the information that was given out. Again, Securian, top-notch carrier. Their underwriting has been phenomenal lately. So I do want to make sure I mention that their underwriting has been doing really well. And both the Secure Care and their Eclipse IUL product, Eclipse Protector, perform well when you stack them up against other carriers out there. So if you have any cases that you're working on, please reach out to your marketer here or myself personally. We'll be more than happy to discuss any cases that you have coming up or any cases you may be having some difficulties with. You can reach us at 561-241-4500, but definitely check us out on the web, bestagency.com. Once again, Rob, thank you very, very much. We appreciate your time, and I will be in touch with you on some of the other cases that we were discussing.
Awesome.
All right.
Thank you. Thanks for joining today.
Absolutely. Thanks, guys. Thank you, everyone.